So who is Phil? Who am I? Yeah, I graduated from FIU close to 20 years ago now with degrees in international relations, geography, and economics. I wanted to be a diplomat, get into the State Department, and then I heard you can spend your whole career in the State Department and be a deputy ambassador for a country, and then they'll appoint someone else that has nothing to do with the State Department. I said, I don't want to do that. I don't want to spend my life working for the government. I was in the Army. I know what that's all about. And so I got into the mortgage business in 2005. Which we know what happened soon after. There was a big crash, but I stuck through it, through all of that. So I'm an Army veteran. I was deployed to Afghanistan and Iraq. As I said, I started mortgages in 2005. I opened my own mortgage company in 2012. I got through the crash because I did a reverse mortgage for my grandparents. It's a highly misunderstood mortgage. If we have time towards the end, I have some slides that could explain what that is. I did a reverse mortgage for my grandparents. I joined a company that was offering reverse mortgages, and we took off while everyone else was getting out of the business completely. So for years, 2015 to 2017, I only offered reverse mortgages in my company. We were the top one in Florida producing reverse mortgages. I actually came out in Forbes 3 times as a reverse mortgage expert. As you can see up here, you could Google that and find those. I'm a certified reverse mortgage professional since 2014, which is only like 200 or 300 in the country with the certification. And I was on the ethics committee of our National Reverse Mortgage Lenders Association. You know, I believe a lot in doing things ethically in the business, especially in reverse mortgages where people can be taken advantage of and lied to. So I own several businesses. My mortgage company is the main one, 4 residential properties and 1 commercial building. I say that because I put my money where my mouth is. A lot of people in the mortgage business and real estate, they tell you you need to own, but then they don't own their own commercial space. So that's who Phil is. You know, as I said, Phil Stevenson is my name, but who is Felipe? My mom is Cuban, my dad is from South Carolina. So I always like to joke around and say I'm a Cuban cracker. I tried that joke once in Naples, Florida, and nobody got it. You know, you got to be in Miami or be Cuban to understand what a Cuban cracker is. Things we're going to talk about, different market trends and predictions, and kind of debunking some of the stuff you hear out there. Housing supply versus demand. I mean, this is economics 101. Most of the people out there that make videos, including reporters, talking about there's a market crash coming or anything like that, they have no basis. They have no education, you know, higher level education on economics. And supply and demand rules everything. Regional market differences, so economic factors. I love charts. I love digging into different charts because charts tell us a lot. Not emotion, not what people think, you know, could happen because they look at 1 or 2 stats that the media gives them. What does the media do? How does the media make money? Scream it out there. How do they make money? Clickbait. Something that grabs your attention, right? And then through that attention, they advertise. What's the best way of getting someone's attention? Fear. Fear and sex. You know, real estate's not sexy. I guess sometimes it could be. It's fear. So what's actually happening to your body is they activate the amygdala through fear, which causes you to pay more attention, which in turn makes more money for them. So every year there's a crash coming. Ever since the last crash, there's been a crash. I don't care what year it is, someone's talking about a crash. So first of all, median value. Does anyone know the difference between median and average? Average is you take the numbers, you add them up, and you divide it. But they don't do that with mortgages, with real estate. They look at the median. What the median is, if the median value is rising, that means that you have more sales at higher values selling than those at lower values. If median is falling, that means you have more sales at lower values. Let's say in Miami, 300,000 to 500,000, there's a lot more of those selling than the $2 and $3 million properties. That enough could be dropping median price. Now, of course, you could have certain times where median is rising and it's because all values are rising. But that's sometimes. So it's like a broken clock. It tells the right time twice a day, but not always. So median is a terrible way of illustrating where values are, yet that's what everybody uses. I was debunking someone on YouTube, and he's got a huge following, nothing like mine. He kept using median values in different areas of Florida, talking about this 2026 crash that's coming. And if you look at Miami-Dade or the Florida Keys, median values have dropped. But yet my clients had closed a year or 2 ago that have done refinances. So we have an appraisal from 1 or 2 years ago to an appraisal now, their values are higher. So appreciation is still happening while median values might be falling. Further, you see every year median values go up and down. Every single year. It doesn't matter what market we're in. 2018, 2020, 2022, 2024, it's seasonal values up and down. And this is nationwide. So it's not just Florida. All right, so active inventory, if you hear people saying, oh my God, inventory is rising, this is normal. This is 2018 and 2019. As you can see, inventory was falling in a healthy, regular market. Active inventory, inventory is how many properties are on the market. And again, this is nationwide. So you could see in 2018, 2019, it was already heading down. And then of course, the pandemic came, rates dropped, and inventories dropped because the demand skyrocketed with the lower interest rates. What's funny is I had multiple clients, 3 that I can remember, that when the lockdowns happened, they were under contract. And they all said to me, what should I do? This is scary. I don't think it's a good time to close. I said, do not get out. Close on this, because what's going to happen now, anytime there's something bad in the economy, what do? They drop interest rates to stimulate the economy. So while the economy could be going to crap, real estate picks up. Everyone thinks, oh, what happened in 2008? 2008, the economy went bad because of real estate. It wasn't the other way around. Real estate killed our economy. It had one of the worst recessions we've ever had. So because of all the massive fraud and all this stuff. But whenever there's a bad economy, real estate gets a boom. So they stayed in, they thank me to this day because their interest rate is low and their values have appreciated considerably. So this was unhealthy down here. So now inventories are rising. Long story short, inventory is still lower than it was 2018, 2019. We're getting back to normal levels. So whenever someone out there says, oh, it's going to crash, or this is terrible, values have to come down, values do not have to do anything. They do what they do. Affordability has many factors: price, interest rate, taxes and insurance, different costs. It's not just the value of the property. So when interest rates come down, affordability goes up. My opinion is get in before the interest rates come down, because then you can just refinance and let everybody else battle each other out. Foreclosures. So foreclosures before the 2008 crash were almost double the COVID years. You see, this is before the crash. This is 03, 04, 05, 2003 to 2006. Foreclosures, look how high they were here compared to 27 through 2019. Why? Mortgage guidelines. Mortgage guidelines were very loose back here. It was a big problem. It's a big reason why we had a crash. Mortgage guidelines are extremely strict. They got stricter during COVID because they wanted to make sure, especially self-employed people, could actually afford what they were getting into. And they've kept them there. They haven't changed those strict guidelines. So with the lower foreclosures now from what we had back here and back here, it's whenever you see the media say foreclosures are up for 30%, people think, oh my God, that's terrible. No, look, let's zoom out. Always zoom out. We're nothing like this. We're not even anything like this. We need to get up here. We need foreclosures. We need, I feel bad for those people. I had foreclosures actually. 2008, I went through a bankruptcy. I had 7 properties at that time. I went through a bankruptcy. I got foreclosed on. It's a normal part of the market, and, we need those. So another chart just to illustrate the foreclosures in a different way, but you could see 367,000. Before COVID, it was 493,000. And back here, we're in the 500s, 700s. In a good place right now. And foreclosures are always an indicator of values dropping, because the more people that can't afford to stay in their homes that are letting it go, they've got to cut prices. But if they have equity, they just sell it for a profit. I don't understand how people can be in foreclosure or get to foreclosure in this market, as most have equity. Average days to foreclosure, foreclosures used to be much faster. Now it's harder to do it. After Dodd-Frank, it's much harder to foreclose on someone in a primary residence. All right, so this is what I end up seeing all the time. I'm always tracking mortgage applications, because mortgage applications teach us a lot, not the refinances, this is purchase applications. So if you see 2024, towards the end of the year, there was a spike. You're going to see in a little bit why. It's because mortgage rates dropped at the end of last year. But then they did the same thing this year. It's September of this year, we saw drops in mortgage rates, which means the purchase applications increased. But mortgage rates actually spiked again right after the drop in 24. So if we have much higher purchase applications than we've had over the last 2 years, that's a good sign in the real estate market. This one's a cool chart. It shows you negative equity. You could see everybody that was upside down in 2013 that had negative equity because the values fell and they were coming back up. And now it's almost non-existent, the negative equity. And then this is loan to value. That means they owe between 91 and 100% of their value. Very few. And the same, 81 to 90. Look at 2025. It wasn't even flowing in the same direction. Now it jumped up even more. There's even more equity in people's houses, or they owe a lower amount versus what their value is. And right now, mortgage rates There's more people with rates under 4% or just about the same as people with above 4%. It was a big difference, but now they're kind of coming together because there's just more and more people getting mortgages since 2022. All right, so who's heard of the Federal Reserve? We all have. It's big news now. Actually, Kevin Warsh, the guy that's going to be the new Fed chair, I saw a video on him talking about how before the 2008 crash, the Federal Reserve was not headline. It was like they'd only hear about them when they were going to cut rates or raise rates, and they were only there for emergencies. And they came out big in emergency in 2008. But since then, they've been like a big driver of the economy, the boom and bust cycles, and probably too much influence. But did you know that the Federal Reserve is neither federal nor a reserve? They're a central bank. There's actually a really good book, The Creature from Jekyll Island, that I highly recommend. It talks about the origin of the Federal Reserve. It was a secret meeting done by big-time bankers. Of course, banks were going under a lot back then, but there's a lot of conspiracy theory around it, but it's a great book because it teaches you the origin of it. Either way, in my economics class, of course, I was in my early 20s and I had no idea what my professor was talking about, but it sunk in because he kept saying the Federal Reserve does not control interest rates. The Federal Reserve does not control interest rates. Yet everybody thinks when the Federal Reserve comes out and says we're dropping rates 0.25%, that they control interest rates. No, they control the money supply. So they buy and sell bonds, they do different things to try to get to that rate. And that's the rate at which they'll lend to banks. But the banks don't have to follow it. They move the indexes. So the Federal Reserve does not control anything. But they have way more control of the Fed funds rate, and they have zero control of mortgage rates. Yet everybody thinks when the Fed drops rates, mortgage rates are dropping. So this is only last year, the 3 Fed rate cuts at the end of 2025. Mortgage rates, this line is mortgage rates. So we can see mortgage rates were over 7 here. Then they dipped into the high 6s, came down to the low 6s before the Fed ever cut the rate the first time. Fed cut rates, rates go up. So every time we've seen a Fed meeting, usually that day mortgage rates have gone up. And I try to tell clients, I'm like, listen, don't wait for the Fed. Lock your rate if it's good before the Fed cuts rates. Because sometimes this is a bond market. The bond market drives mortgage rates. So I told you the Fed doesn't control it. It's a bond market. It's just like stocks. So the investors that buy and sell bonds will buy and sell based on news that's out there. The news could be the Fed cutting rates. There's a saying in stocks and bonds and everything is buy the rumor and sell the news. So the rumor of a Fed rate cut coming drops rates because they're buying the rumor and then they're selling the news. So that shows you the Fed has zero control of mortgage rates. And actually, if you hear the Chairman Powell, he says, we don't look at the long end of the curve, meaning long-term rates like 30-year mortgages. They look at the short end, which is the Fed rate. So the Fed rate controls credit cards, car loans, lines of credit, things like that. Commercial mortgages do because those are typically short-term, 3, 5, 10 years as well. All right, so this is, you could Google average 30-year fixed rate to see what the average is. It doesn't mean that that's what the rate is that you're going to get. It just means the average of everybody putting large down payments, good credit, bad credit, paying points, whatever their rate ends up at, this is what they get. September 2024, the first time the Fed started cutting rates in the last several years, this is where mortgage rates were dropping hard. And I was telling people, just don't wait for the Fed, lock in a refinance now. We did a lot of refinancing back here, and then the rates jumped up. They peaked, actually, that day is the inauguration of our current president, January 20th, and then they started coming down. This was April, this was the tariffs week, remember Liberation Day and all that. So what's funny is that average is kind of high, but I was locking people in at interest rates down here because lenders were offering specials to get them lower, and it was 3 days, and that was it. There were people on the Friday after Liberation Day that were like, okay, now I want to refinance. Come Monday, it was spiking, and that's it. They lost out. A lot of them ended up refinancing with me later on over here. But whoever mortgage professional is that you're working with or talking to, they need to understand this. Most of them don't. What they tell you is just hurry up and lock at the beginning of the process, but they don't understand the ebbs and flows of it. I've been studying it for 20 years on top of my economics degree. This lowest point right here, I'm going to talk about it a little bit in another slide, was when Trump announced the $200 billion of buying of mortgage bonds a few weeks ago. And they're not actually buying them, but it caused the mortgage bonds to go up in price, which means rates come down. And so rates actually dipped a little bit. This shows that it didn't even go under 6, but some estimates say it did drop below 6 and all this. The end result, the end point of all of this, the Fed doesn't control mortgage rates, and mortgage rates are constantly moving up and down. Now they're higher. There's people that didn't lock with me the last couple of weeks or in December, and now their rate is higher. All right, so some of you might be triggered by Trump. Some of you might love him. It doesn't matter. Here I'm going to talk about whether his recommended changes or his administration's recommended changes are BS, that's a technical term, or good. And so the 50-year mortgage, who thinks that's good or not? Raise your hand if you think it's a good option. I don't. I don't, because 40-year mortgages exist and nobody uses them because the payment goes down a little bit, your rate is higher, you pay more interest long term. It's just not attractive. It's not attractive, so I feel the 50-year will be the same. Institutional buyers, we remember during 2020 and 2021, all these big companies buying real estate. Back then I said, I'm like, it's not a big deal. It's really not, and it really isn't. It's 1 or 2% nationwide, but I did hear people make certain points that in certain areas, there's a lot more than 1 or 2%. And if you're the one that's trying to buy a property and you're a first-time home buyer putting 5 or 10% down and you keep losing to big investors, it hurts you. So it will have a good impact, I think, overall. So that one I think is good. I should have done like a little, like highlight. I'll do that for my next presentation. Highlight the end result. FHFA is what controls Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the secondary market for conventional loans. Pulte is the chair of that now. Pulte Holmes he was the CEO of it, and now he's given his kids the reins so that he could be in the government. So this is Trump announcing the $200 billion. At first I was like, $200 billion, it's a drop in the bucket. But I heard, which has not made headlines, that they used to have a cap of $40 billion that they could buy. It's not new that they buy mortgage bonds, but they were capped at $40 billion each, Fannie and Freddie, so 80 a year. And they had to increase that, but they didn't increase it to 100 each, they increased it to 225 each. So there's a potential that this could be a 450 number per year, so that whether you like it or not, so that the government has more control of lowering interest rates is basically what will happen there. So it could be good for the housing market. Assumable or portable mortgages. Right now, VA mortgages and FHA mortgages are assumable. I'm a veteran, which means my VA mortgage, which is 2.25%, another veteran can come and buy my house using their entitlement. It's a little complex, but they'd have to use their entitlement, or I give it to someone and I lose my entitlement, so I can't go get another VA loan to be able to sell that house. But it's rare that those happen because they can only take the value of my mortgage now. They'd have to put a large down payment. Usually VA mortgages are zero down, so they don't do it. FHA is the same, they're assumable. So portable is really what they were talking about, where if you have a low rate, you can take it to the next property. Sounds amazing, but in reality, is it going to work? Does the lender want to do that? They're going to have to do work now, next time you buy a house, to make sure you could afford that house, to make sure you could take on that loan, and so they're going to need more income to do that. So how are they going to make more income doing that? In the very beginning, they're going to charge you a higher rate. So people are going to say, well, why would I do the higher rate when I could do a lower one now? I don't know if it's going to have much traction. And then the last one is 401k for down payments. You can do that now, but there's a penalty. Or you can borrow from your 401k. So they want to take away the penalty for you to be able to do that. That might be good, especially since you have certain versions of it now. 401ks might not perform well because it depends who's managing it. But either way, I think overall, whether it's BS or it's good, the fact that we have an administration focused on housing affordability, focused on making things better is good. So any changes that come of it, whether they're slight, whether they're great, whether they're not, I think it's just a good direction for us to go in. All right, so this should affect everybody here if you own property, even if you don't. A lot of controversy behind this. So Ron DeSantis has come out talking about property tax reform. What a lot of people don't understand is the numbers. The knee-jerk reaction is when people say, oh, eliminate property taxes, they say, oh, what's going to happen to police and firefighters and teachers, right? Because we fund schools through property tax and other things. What he's saying is not eliminate all property tax, let's eliminate 30% of our homestead properties. So that's investment, commercial, second homes, a lot of second home owners from out of state. 70% of all our property taxes are those that would stay under his proposal. Now, here's where a light bulb went off for me. In 2019, I've seen different numbers. So I just used the average. $31 to $32 billion was our Florida property tax revenue. That's how much money all the municipalities made from property taxes. 5 years later, it was up to $56 billion. It went up 75%. Where's that money? It's not going to the teachers and the firefighters and the police, right? So where's it going? The politicians and the municipalities are finding things to spend the tax money on. It shouldn't be that they just they raise our taxes and they charge us more money. We should have a say in it, in my opinion, as constituents, as homeowners, as whatever, to approve whatever they're increasing the taxes on. So if we take off the 30% in taxes, we're still going to have a 23% increase from what we had in 2019. So there's still going to be a huge increase. They're just not going to have all that waste, and then they'll have to come out and ask our permission for anything else that they need money for. And maybe it goes to hotel tax. Maybe it's half a penny on sales tax. Who knows? People say, well, this is terrible for renters. No, this is phenomenal for renters. If you can knock off $500 a month from your mortgage payment and you're a first-time home buyer, what happened to affordability? That's huge. Rates go down, this comes off. Now, values are going to go up, yeah, because you're going to get a lot more buyers. So get in while you're a first-time home buyer and take advantage of it, and don't wait for that value to start going up. This won't take effect, if it takes effect, until the end of 2027. It would be on the ballot this November. 60% has to pass. DeSantis wants it to go to a referendum, and then they come up with one plan, which his is this one. And then once the legislators agree to that, it goes to the vote in November. And if it passes, then they're going to figure it out. I've seen that they would actually slowly integrate it over a few years. So it wouldn't be an immediate cut. It would be a reduction. So there's a lot of things out there. I think it's a great idea. I actually don't pay property taxes because I'm a disabled veteran, and we don't pay property taxes. So I have no skin in the game personally. Of course, in my business, there's a lot because my business will increase with this. I told you I do reverse mortgages. I can't tell you how many people. I've closed over 1,000 reverse mortgages. That means I've spoken to or met with well over 10,000 people, because it takes at least 10 meetings to close one, way more than that, about their finances. I can't tell you how many people make $500, $700, $1,000 a month, and their house might be paid off and they have to pay property taxes at 60, 70, 80 years old. That shouldn't be. Even if they say 55 and over pays no taxes, and then we get a 50% discount under that, I think that'll be great too. But something has to change. We shouldn't be forced to pay property taxes our whole lives on a property we already own. Any questions on anything I've gone over so far? Any interaction, any comments, any,
Let
no?
me ask you a question.
Yes.
Do you work with the states? Like, we have clients that sometimes come with properties and they have reverse mortgages on them, okay? Obviously, the person that obtained the reverse mortgage is not deceased, and the new beneficiary would like to take over the property. Do you work with that?
I give advice on that. My business is originating the loan, it's starting the loan, but I'm also huge, as you saw, ethics committee and all this stuff, on making sure that the negative press we get is minimized. So what happens in that case, in a probate case, is first of all, the heirs don't act fast enough. Maybe they don't communicate with the current lender, and so they start a foreclosure process. And then it's like, oh, the reverse mortgage is foreclosing on us. No, if they communicate and they do things right, they have up to a year, is the rule, to somehow pay off the loan. Probate lasts over a year sometimes. No, it doesn't last over a year? No? Oh, okay. So then it's changed. Not here in this office, you mean?
Usually, the rule is that it should not be open for over a year. We do have probates that exceed when there's litigating parties, but usually the norm is like 8 months.
When it's an uncontested one, it's quick. Okay.
It's very simple.
Gotcha. First of all, I would recommend a life estate deed. Before, so at closing of the reverse mortgage or during the process, do a life estate deed. If there's no trust, trust is way more expensive, but I do a lot of life estate deeds for my client. Not that I do them, but we get the attorney to draw them up and then we close with it. That's the best way, because as soon as they pass, the owner is now the heir. They can sign whatever they need to sign.
It makes perfect sense, because obviously that the death of the person triggers the life estate to come into place. Then the mortgage company would reach out to actual owner of the property and tell them, hey, this is the amount that's due. You need to pay this within a year in order to receive the possession of the property.
Yep. And then they could tell them, yes, we're selling, we're refinancing, what have you. There is a rule, which is a cool rule, where the heirs can buy the property at 95% of the value. This is only good when the property is upside down. So let's say they owe $400,000 on the reverse mortgage because they did it decades ago. That's the only ones that'll be that way, and the value is $300. Well, they could actually buy it at 95% of the $300. They could buy it at $285. So they're getting a discount, and there's a loss of $115,000. The lender doesn't lose the money. FHA's mortgage insurance steps in and funds it. And their mortgage insurance fund is ridiculously huge right now. What makes reverse mortgages expensive is the mortgage insurance. That's the FHA reverse, but there's now private reverse mortgages also. So,
Let me ask you another
yes.
question. So let's say that we get one of these very interesting cases and we send them your way. Would you be able to help them?
The ones that the borrower has already passed away,
Yes.
I would be able to guide them in the right direction on what to do. So in that case, I would say from the sounds of it, you should call the current lender, the current servicer, and ask them about purchasing the property at 95%.
Okay, so that would be like, that would be what you would tell them, so why bother you? I would just tell them that directly.
Yeah, if you can, and but again, I don't mind helping in those cases because I believe in the overall picture of the reverse mortgage, so I don't mind taking the time to have a phone call and help the people understand what their next steps are. And then if they're getting a hard time from the idiot in the call center at the servicer, then let me know, because I'll go through our national association. I've gotten to the CEO of the servicing company sometimes, and then all of a sudden everything gets fixed.
I just want your card.
Yeah. Okay, it's there, but there's more here too.